Pull your money out now. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, we have a bombshell report on why you should be pulling your money out of your JPMorgan Chase account and closing it immediately. Plus, we have new data that shows things in China are getting worse. And are there signs that this U.S. inflation story will soon turn to deflation? Let's head over to Bloomberg, where we picked today's story up with a headline: JPMorgan grows even bigger as the U.S. bank giants soak up assets. And this is one of the problems we're seeing in the banking industry, that the small and mid-sized banks are desperate for money, and yet these big banks, JPMorgan, now the biggest bank in the country, is just soaking up money at a fast rate. And this is going to become a problem, particularly during the next banking crisis, because you'll watch and see the government is going to need these big banks to absorb some of these smaller banks, making JPMorgan not only too big to fail as it is now, just too big to begin with. Perhaps it will put pressure on Congress to even look at splitting the big bank up. More than 70% of aggregate asset growth in major U.S. banks was concentrated in the 10 largest lenders, which saw a combined $630 billion increase in the first quarter, with also including assets tied to more recent mergers and acquisitions. JPMorgan saw its assets increase by an eye-popping 8.5% that period, including growth tied to the May 1st acquisition of First Republic. First Citizens Bancshares saw its assets nearly double from the previous quarter, driven by its decision to buy Silicon Valley Bank. And assets in New York Community Bancorp jumped 37% after a subsidiary took over key parts of Signature Bank. So we know in the coming crisis, banks like JPMorgan are going to get bigger and bigger and bigger. And at some point when you're that big, you have not only just regulatory issues, you start to seemingly get away with things that you shouldn't. And when that happens, Congress isn't going to be too happy. Going forward, once this current banking turmoil subsides, we could potentially see a new era of mergers and acquisitions ushering in. I think you could see larger regionals combined with smaller banks just to gain the scale needed to deal with a tougher regulatory environment and tougher earnings backdrop environment. And that is generally true. And as we know, Treasury Secretary Janet Yellen suggested there were going to be mergers in the future, which of course is a troubling sign that one makes us wonder, what does she know that's going on behind the scenes? The problem here is, it's not that these mergers won't be a good idea. The question is, are these banks even going to survive? And that's where, of course, we know banks like JPMorgan are going to come in on the cheap and scoop up more and more of these banks, and putting them so big that perhaps you'll find a reason why you need to get out of them before it's too late. The rise in total assets also comes as banks await higher capital requirements from U.S. regulators who aim to bolster financial systems. Large U.S. banks, this would include JPMorgan, may have to boost their capital by an average of 20%, and a broader swath of lenders would face stricter requirements for setting aside money. Now, this would give JPMorgan a massive disadvantage if it had to take 20% of its assets and put them in reserve against new capital requirements. It means the interest they'd be paying on their accounts is going to go down, making some of their competitors much better options. But that's not just a part of the story. We now see the Fed emergency bank bailout facility usage is new record high as retail money market flow inflows continue. And here we can see now, as of yesterday, we have the latest data on the Bank Term Funding Program hitting over $103 billion. And that is a record high, my friends. And all it's telling us is the stress in the small and mid-sized banks is not going away. We know there are going to be more failures here. And of course, Jamie Dimon, the CEO of JPMorgan, he can't wait to get his hands on them. The problem is, now you have a case, JPMorgan will be so gigantic, it will be virtually impossible to control. And here we can see now, looking at that bank term funding program, we've got this against the yield curve. Now, this chart doesn't tell us much because this is a brand new program, but you can see the yield curve. You can almost see how the bank term funding program started to just slow down its growth as the curve further inverted. Of course, now we know that more banks are tapping their funding program because, as you know, banks borrow at the short end of the curve, lend at the long end of the curve, and when short-term rates are higher than long-term rates, well, you don't make money lending. puts pressure on you as a bank. They've got to go to the Fed to get money because we're still seeing deposit flight headed over to banks like JPMorgan. But one thing that shouldn't be used, you need a bailout, well, that's your trading account. We now have a new update. You've been waiting for this. Now, this is looking back at our CTA-Timer Pro. Link in the description below for $30 a month while supplies last. It told you to start buying down here at this bottom when no one wanted to. And if you missed that and said, I'll wait for the next pullback, and many of you tried to but missed this one, it said buy here, and we told you when it would flip the signal. Well, I'm going to show you today here looking back January 9th, this machine program. This is what it does. It looks at how the machines are trading, runs a historical overlay. Here we can see the short covering begin on January 9th, giving you the first signal to buy in. Here it was back on March 15th. If you missed that first rally, we saw the machines pull back and start buying again to the upside. And now look, here it is, June 30th. Today's report is starting to back off those longs. You see it drop from 100 to 55% long. Now, what does this mean if you're a subscriber, you want to be a subscriber? It's telling you at this point, raise your stop loss levels up, maybe take some gains and look for the next opportunity. Again, link in the description below, because now we're seeing bigger problems at JPMorgan, and it's not just easy options. We're seeing serious issues under the covers. As JPMorgan finally agrees to pay a $290 million settlement to get out of the Epstein suit. But here's the issue here. We look back at the anonymous women who filed the suit, claimed the bank negligently served as a late financier's banker. Here's the key part. Even though it knew of his abuse of young women and girls, Epstein was dropped as a client in 2013 after further allegations of his sex trafficking began to emerge in the press. So you look under here and you wonder, well, what else is JPMorgan up to? Who else are they having as clients? Well, it seems like everybody's going to be a JPMorgan client, but they look the other way because of money. But now look, this is a bombshell report. We got this today. As JPMorgan mistakenly deleted 47 million records, according to the SEC, they now have to pay a mere $4 million. This is nothing to JPMorgan. And they said, hey, we've asked for these records and you deleted them. The SEC alleged Thursday that JPMorgan Securities permanently deleted 47 million electronic records, including emails and instant messages from January of 2018 to April of the same year. As a result, the regulator said that JPMorgan could not come up with the requested documents in 8 SEC investigations. Get that, 8 of them, and 4 other regulatory probes. The SEC didn't say whether those actions were focused on the bank, but notably look at all of this activity going on at JPMorgan under the covers. It makes you wonder what's really happening, who's really driving this ship. In 2021, and see, it didn't end then. The bank paid $125 million to the SEC and $75 million to the Commodities Futures Trading Commission to settle allegations that the firm broke rules by not saving business communications on platforms like WhatsApp. So here we can see more flagrant following of or disregard of the rules by JPMorgan. Again, as we head into the next financial crisis, banks are going to become center focused. JPMorgan's going to be snapping up these small banks. It's going to get the attention of Congress, which is why I think at some point in the future, what we're going to see is these big banks get split up, because we're going to have too many big banks. They're going to get split up by Congress. They'll still be under the Federal Reserve System, but watch and see what's about to come, because Jamie Dimon, he knows this is coming, and here's the proof. Dimon hinted life after JPMorgan said he'd consider public office. Now, why would he do that? Because it's really simple, my friends. We're going to go through this banking crisis. Many small and mid-sized banks are still yet to fail. It's going to happen. He's going to run to the savior. You watch. His bank's going to buy some of them up, but not all of them. He's going to work with the other CEOs and broker deals, and he's going to look like a hero to the American public, and that's going to put him in a position to run for office. I love my country, and maybe one day I'll serve my country in one capacity or another. And this is when he's asked by Bloomberg if he'd even consider public office. His comments made at the bank's annual Global China Summit in Shanghai come as the U.S. gears up for its 2024 presidential race. Now, why would he run for office? Well, simple. If he knew the bank that he loved and helped build so much was going to get broken up by the government and face that risk, well, there's one good way to try to alleviate that problem, and it would be to run for office, potentially president. So what do you think? Would you vote for Jamie Dimon? Do you feel confident in having them as your bank, or does all this new news give you reason to look perhaps elsewhere? And talking about elsewhere now, let's head over to China, where things are getting worse. China's economy shows new signs of weakness as manufacturing is now contracted for the third straight month, and it gets worse. China's manufacturing sector contracted for the third straight month in June, and the non-manufacturing sector weakened. Now, we shouldn't be seeing that. When we talk about the services sector here, everyone now believes that the services sector is mega strong and it's going to drive the global economy higher and pull the manufacturing sector up with it. But now we're seeing in China that the services sector is weakening as well, with new orders falling for both the country's official statistics agency said on Friday. But get this, employment declined across both broad sectors, an indication that a nagging job shortage, particularly for young people, is worsening. So here we see the opposite. In the U.S., we have too many jobs, at least that's what the data says. We have so many open jobs, but we're seeing new orders slow down. And this is a key component here, because when you see new orders in China slow down, and they're the world's exporter, well, where do you think those new orders are coming from? Well, the rest of the world. The data will likely prompt officials to provide more easing to the economy. The trade component of the economy has really deteriorated. Again, global trade comes back. We talked about that in the show the other day. This is critical. We're seeing a slowdown in global trade. And when you're in China, it means you slow down in your manufacturing sector and eventually layoffs. But again, everybody's been pinning the recovery not only on China, but their consumers in the services side to lead the world out. But maybe it's not going to happen. China's official manufacturing purchasing managers index rose slightly to 49 in June from 48.8, suggesting that the manufacturing sector is still contracting, although only slightly. But get this, a sub-index on employment shrank to 48.2 in June, a contraction for the fourth straight month, highlighting the continuing stress in the labor market. The unemployment rate among workers aged 16 to 24 rose to a record 20.8% in May, in part due to the evaporating jobs in the manufacturing sector, which, as I've been saying, my friends, is soon coming to America. Meanwhile, activities in the services sector, again, what we're hoping is going to lead to turnaround here. A key driver of China's post-pandemic recovery softened further in June to 52.8 from 53.8 in May. That marks the lowest reading since last December, when Beijing abruptly scrapped the COVID-related restrictions. An index of non-manufacturing sector employment came in at 46.8, registering the fourth straight month of contraction. The index for new orders at 49.5 showed a contraction for the second month in a row. So here what we're seeing in the U.S. is an increase in hiring in the services sector. Well, in China, we're seeing layoffs there, making us wonder now, are we only a matter of a couple months as we get through the summer before we see big layoffs in the services sector here? Well, I think that's a likely case, because now we're seeing U.S. inflation cooling, perhaps turning into deflation soon as spending stagnates. And this is critical because we know when spending stagnates, well, you don't need workers as economy loses steam. The Personal Consumption Expenditures Price Index, one of the Federal Reserve's preferred inflation gauge, rose a mere 0.1% in May. From a year ago, the measure stepped down to 3.8%, the smallest annual advance in more than 2 years. So now we're on the cusp of seeing the PCE already heading toward deflation. Now, why does the Personal Consumption Expenditures matter? Well, it matters because it is the Fed's preferred gauge here, and it tends very slightly to lead the Consumer Price Index. So based on this report, we can already tell the upcoming CPI report next month will likely show further declines, as you can see in this chart here. The Personal Consumption Expenditures Chain Type Price Index, this shown in blue, against the Consumer Price Index for all urban consumers, that's shown in red. And you can see it's a little hard to see right now, but if you go back here in the 90s, you can see the blue does indeed lead the red line down. So where PCE heads, of course, we know the CPI falls. Here we're seeing it lead, suggesting that the Consumer Price Index is indeed headed lower. And when excluding food and energy, the so-called core PCE increased 0.3% from the prior month and 4.6% from May of 2022. Now remember, the core is what right now the Fed is fixated on because they're seeing the headline numbers come down. They're seeing the CPI come down, seeing the PCE come down. So when they're still not getting what they want, because what do we know what they want? They want to raise rates even more. Well, if you need to do that, you got to change your benchmark. Now we're fixated on the core PCE, the core CPI, and all that's a matter of stripping out food and energy, and you see it still rose at 0.3% and slowed slightly to 4.6%. But of course, economists could consider this to be a better gauge of underlying inflation, which it is, as I showed in the show the other day, until it starts to turn down. Consumer spending, and here's your indicator, it is going to turn down. Adjusted for prices was little change after a downwardly revised 0.2% gain in April. From February through May, household spending has essentially stalled. And after an earlier surge, spending on merchandise dropped while outlays for services increased. So we're already seeing signs the spending is indeed heading lower. It's being headed over to services, but for only a question now of how long that lasts. My guess, maybe we have another month or two. What do you think? Because I'm guessing by the end of summer, it's going to be pretty obvious that we're in a recession. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.